Over the last year, we've had about 63% exposure on average to equities, and we've been net sellers of equities in the last few weeks with the big moves we've seen in markets. What we effectively do is we divide our portfolio into three risk buckets: high risk positions, medium risk positions, and low risk positions. And we do this in quite a scientific and quantitative way. The way we determine if a company goes into one of those risk buckets is based on its forecasting risk as a result of our research process. What's been interesting and what an investor should expect from us is our high risk buckets should deliver the highest expected return. And that is precisely what's unfolded in the last 12 months in our portfolio. So the high risk stocks have been giving returns well in excess of 20%, and those prospective returns are slowly diminishing as those companies get repriced. So what we've been doing is we've been selling out of our high-risk positions and moving our exposure in the portfolio to our medium-risk bucket. The reason why we prefer the medium-risk bucket at this stage, not only are the prospective returns not too far off the high-risk bucket, but they're coming out of a different vector. So the medium-risk bucket is a function of earnings growth coming out of those companies, the medium-risk companies, as against the high-risk bucket where it's more a re-rating in the PE, which we've already seen happen specifically in 2016. So there's a definitive migration of exposure to lower risk positions in our portfolio. That's the first thing we've been doing. The second is just net selling. When stocks reach their intrinsic values and start moving through the intrinsic values to their bull cases, we've been exiting positions in our portfolio and building up some cash. What's also been happening is we've been specifically selling offshore, but predominantly our US exposure, which is re-rated aggressively this year. We've held our positions in Asia and we've held our positions in Europe, which we still feel are undervalued. Holistically, if we take the portfolio as a whole, our expected returns coming out of the portfolio are over 20%, a mixture of low risk, medium risk, and high risk stocks, which we think is well in excess of what you're going to get out of the market in the year ahead.